Hello and welcome to marketing91.com. Let's start with understanding inflation. Inflation is a state in which there is sustained decline in the value of money, that is, a sustained increase in the price level. In single-digit inflation, prices rise by 0 to 9.99% year on year. In double-digit inflation, prices rise by 10 to 99% year on year. Concepts of inflation are headline inflation, core inflation, food inflation, and retail inflation. Headline inflation, also known as top-line inflation, it is a measure of the total inflation within an economy. It is measured using the Wholesale Price Index or WPI. It is the current rate of inflation at which prices are rising and is affected by sudden changes in the prices of food and energy products. Next is core inflation. It is a measure of inflation which excludes temporary price volatility, as in the case of commodities such as food items and energy products. Core inflation, CI, is equal to headline inflation, HL, minus food and fuel prices, FF. That is, CI equals HL minus FF. Core inflation is of considerable importance to businesses for making investment decisions, to households for making spending decisions, and to policymakers for making monetary policy decisions, because it makes them aware of the economic scenario in the future based on current growth trends. The core inflation in India was at 6.83% as of April 2016. Food inflation is calculated using the prices of food articles in the primary articles group and that of manufactured food products in the manufactured products group. Primary articles group items include rice, wheat, pulses, vegetables, potatoes, onions, fruits, milk, eggs, meat and fish. Manufactured food products include tea, sugar, gur, oil cakes, etc. Food inflation affects the poor population the most because they spend a higher proportion of their income on food items. Statistics. For the period December 2015 to May 2016, the 6-month average food inflation rate in India was 5.74% for the food articles in the primary articles group and 4.99% for the manufactured food products. Retail inflation is measured using the Consumer Price Index or CPI. Retail inflation measures price changes from the perspective of the retail buyer. It is designed to measure changes in the level of retail prices of selected goods and services on which consumers of a defined group spend their income. There are consumer price indices for urban and rural regions and laborers in different sectors. Moving on to demand pull inflation. If demand has a greater impact on increasing prices, the situation is termed as demand pull inflation. An increase in demand may occur due to an increase in the income of consumers. It may also be the result of monetary and fiscal measures taken by the government, such as welfare measures, increase in government expenditure, reduction in taxes, and other measures which increase the disposable income of the people. For example, after a restaurant gets a rave review, greater demand will allow the restaurant to increase its prices. Demand pull inflation can be diagrammatically explained as follows. SS1 is the supply curve. OP1 is the price determined by the interaction of the demand curve D1 and the supply curve SS1. The demand curve shifts from D1 to D2 up to D5, and accordingly the price level increases from P1 to P2, P3 up to P5. The supply responds to an increase in demand up to point C where the economy reaches its full employment level or YF. Thereafter, the supply curve becomes vertical, indicating perfectly inelastic supply due to full employment. Now let's look at an example of demand pull inflation to understand it better. In June 2016, the government broadly accepted the recommendations of the 7th Central Pay Commission to roll out large salaries and pension hikes to employees and retirees. 47 lakh central government employees and 53 lakh pensioners benefited from this. Due to this, demand is set to get a big boost. However, it may fuel inflationary pressures and threaten fiscal discipline. The next type is cost push inflation. If supply forces or cost forces push up the price level, the situation is known as cost push inflation. increase in the prices of inputs such as labor, increased profit margins of business firms, and monopsony in the factor market may push up prices because the seller is in a position to influence the supply price. Supply shocks may also affect the cost of supply because the same or even a reduced quantity of goods and services may be supplied at a higher price owing to increased costs. For example, an increase in the price of oil increases the cost of production for almost all goods and services and results in an inflationary environment. Such inflation is cost push inflation. Similarly, events such as labor strikes, wars, and floods tend to reduce supply and increase prices. Cost push inflation can be diagrammatically explained as follows. OP1 is the initial price determined by the interaction of demand D1 and supply S1 at point A, which is full employment output YF. The supply curve shifts upwards to the left because of the increase in cost. The new supply curve S2 intersects the demand curve at point B, establishing a new but higher price P2. As the supply curve shifts further, the price increases and output declines. This increase in price is solely because of cost push factors. Inflationary gap refers to the difference between the aggregate money demanded for consumer goods and services and their supply. It can be explained diagrammatically as follows. YF is the full employment income. The 45-degree line is the line where income, or Y, is equal to expenditure, E. Point A is the equilibrium point at full employment income, YF. If the total expenditure C plus I plus G increases to E1 shown on the C1 plus I1 plus G1 line, there is excess demand equivalent to AE1 against the available output or real income YFA. The new expenditure line C1 I1 plus G1 intersects the income line OG at E2, resulting in money income OY1. The total expenditure is now Y1E2 against the available output YFA. This excess demand creates an inflationary gap denoted by the distance AE1 equals to BE2. The last topic in this video is on the Phillips curve. The Phillips curve explains the inverse relationship between the rate of unemployment and the rate of increase in money wages. The right-hand side vertical axis scale is higher by 2% than the left-hand vertical axis scale because it is assumed that the average labor productivity grows at the rate of 2%. Thus, the inflation rate is always 2% less than the increase in wage rate. The Phillips curve explains that a nation could buy a lower level of unemployment if it were willing to pay the price of a higher rate of inflation. As more people become employed, wage levels increase, which leads to a greater demand for goods and services. This upward shift in demand results in higher prices, also called demand pull inflation. The long-run Phillips curve is vertical, which implies that in the long run, there is minimum unemployment rate that is consistent with steady inflation. It is termed as the non-accelerating inflation rate of unemployment, NIRU. It is called the natural rate of unemployment. Let's understand it graphically. In period 1, unemployment is at the NIRU. In period 2, due to economic expansion, unemployment declines leading to an increase in inflation. The economy remains on the SRPC, short-run Phillips curve. In period 3, with an increase in the price level and the higher expected rate of inflation being incorporated in wage price decisions, the SRPC curve shifts upwards. The new short-run Phillips curve, SRPC, lies above the original Phillips curve, reflecting a higher expected rate of inflation. The economy moves from A to B with lower unemployment and higher inflation on the SRPC. The actual inflation rate in period 3 at point C equals the higher inflation rate at point B in period 2. The economy may move to C due to a slowdown, with unemployment going back to the NIRU in period 3. In the long run, the unemployment rate will remain at the NIRU. However, inflation will move to point R, that is, above point C, giving a vertical shape to the long-run Phillips curve. Thank you.